Hello, everyone. I am Ingrid, and welcome back to the GMS Weekly Podcast, where we break down the key developments shaping the global ship recycling markets.
And I'm Henning. It's week 28 of 2026. And this week's story is a sharp reversal. Truce breaks, rivers rise.
Exactly. The peace lasted 3 weeks, conflict has returned to the Strait of Hormuz, oil and freight have moved higher, and severe flooding is now disrupting recycling activity in Chattogram.
Let's start with the Gulf. What changed this week?
Iranian projectiles struck 3 tankers in the Strait of Hormuz on July 6th and 7th. The United States then struck more than 80 targets in one night and around 90 the following night.
And Iran responded beyond the strait?
Yes, Iran launched attacks against U.S. military facilities in Bahrain, Kuwait, Qatar, and Jordan. The United States also revoked the waiver that had permitted Iranian oil sales.
So the ceasefire ended very quickly.
It did. President Trump declared the ceasefire over while attending the NATO summit, although he later indicated that Iran was again seeking an agreement.
What is happening with vessel traffic through Hormuz?
Iran has again announced restrictions on passage through the Strait of Hormuz, while maritime authorities maintain that commercial traffic is still moving through the southern route. So the market is once again balancing higher geopolitical risk against a strait that remains operational, but increasingly uncertain.
And oil reacted immediately.
Brent jumped 5.2% to around $78 per barrel, its largest daily increase since May, before easing toward $77.
That is still well below the April peak, but it reverses part of the recent decline.
Correct. Brent was near $71 only a week earlier. Renewed concerns include another blockade and possible strikes on the Karg Island export terminal.
Freight also strengthened.
Yes, the Baltic Dry Index rose for a 6th consecutive session to 2,875, its highest level since June 8th. Firmer iron ore and coal demand pushed the Capesize Index to 4,514.
So the recycling equation has changed again.
Exactly. During the peace, lower oil and a fading freight premium reduced the incentive to keep aging vessels trading. This week, both oil and freight moved higher, giving owners another reason to pause before committing vessels for recycling.
Last week, we were discussing roughly 550 vessels preparing to exit the Gulf.
That exit census now carries an asterisk. The queue still exists, but renewed attacks and falling transit numbers mean owners are reassessing movements and recycling decisions.
And the weather is creating another delay.
Yes, the deferred recycling wave is now waiting under 2 uncertainties: conflict over the Strait of Hormuz and severe monsoon conditions over the Bay of Bengal.
Let's move to Bangladesh, where the weather appears to be the main story.
Chattogram is facing persistent flooding, with extremely heavy rainfall affecting yard production and local market activity. At least 17 districts were placed under short-term flood warnings, while several rivers were running at or above danger levels.
So this is more than the normal seasonal slowdown.
Much more. The monsoon has moved from being a calendar limitation to an operational disruption. Flooding, landslide risks, and continuing heavy rainfall are restricting production and reducing cash buyer demand.
Was there any steel trading?
No trading was reported during the latter part of the week because of the disruption. The latest available local steel indication remained near 66,000 taka per ton, or approximately $535.
How is the taka holding?
The taka remained around 123.2 to 123.3 against the dollar. It stayed above its former trading band, but the move did not extend significantly during the week.
And inflation improved.
Bangladesh's June inflation eased to 9.16%, helped by lower food prices. The IMF also moved toward releasing $1.3 billion, following progress on reforms, while foreign exchange reserves remain near $34.12 billion.
So the broader structure remains supportive despite the immediate disruption.
Correct. Letter of credit availability and plot capacity remain in place. Bangladesh still leads the market rankings, but sentiment has softened, with indicative prices at $455 to $460 per LDT for dry bulk, $475 to $480 for tankers, and $485 to $490 for containers.
The next delivery tide is July 14th to 17th.
Yes, but the condition of the yards and surrounding infrastructure will determine how effectively that window can be used.
India appears to have taken the renewed conflict hardest on the currency side.
The rupee weakened to around 95.5 against the dollar, a one-month low. It fell more than 1% across 6 sessions. And the Reserve Bank of India reportedly sold dollars through state-run banks near that level.
Why was India more exposed?
India imports more than 80% of its crude oil. Brent's move from $71 to around $77 or $78 immediately widened concerns over the import bill.
And the dollar remains another pressure point.
Exactly. The rupee is now dealing with both higher oil and expectations of U.S. interest rate increases. The dollar index remained above 101, while the U.S. 10-year yield was around 4.565%.
What happened to a long steel?
Local steel plate prices firmed from 36,500 to 37,000 rupees per ton. In dollar terms, the move was from approximately $383 to $388 per ton.
India is still the lowest-priced subcontinent market.
Yes, Allen continues to offer the basin's deepest capacity and strongest compliance footprint, with more than 110 valid statements of compliance, but it remains the weakest market on price.
The July 11th to 20th tide window is now open.
Correct, although the monsoon is limiting beaching, and the renewed conflict has delayed the expected routing of vessels from the Gulf exit queue.
Pakistan again seems more stable than the other markets.
The Pakistani rupee held near 278 against the dollar, remaining close to its strongest level of 2026.
Even with the conflict returning close to Gulf shipping lanes?
Yes, the currency has remained remarkably stable through the war, the peace, and now the resumption of hostilities. Pakistan's June inflation also remains at 11.1%, with prices having fallen 0.3% month on month.
But Gadani has two competing forces.
Exactly. Renewed Gulf disruption could restore some of the locational importance that supported Gadani during the earlier conflict. At the same time, uncertainty may again discourage owners from moving vessels toward recycling.
And the new duty structure remains relevant.
Yes, regulatory duty reductions on imported HR prime and wire rod are making those products more competitive against locally recycled and re-rolled steel. That may place pressure on the value breakers can obtain for their output.
Local steel remained firm.
It held at approximately 195,000 Pakistani rupees per ton, or close to $700. Pakistan remained steady in the rankings, with dry bulk indications at $443 to $448 per LDT.
What is the situation in Turkey?
Turkey finally received some encouraging inflation data. June CPI eased to 32.11% year-on-year, down from 32.61% in May.
And monthly inflation was below 1%.
Yes, at 0.99%, the smallest monthly increase in 6 months. Transport inflation slowed as lower oil prices passed through the economy.
But the renewed conflict threatens that improvement.
Correct. Brent's return toward $78 may weaken the oil-related relief before it has time to build. The lira remained near a record low of 46.7 against the dollar.
Does that change Aliaga's recycling position?
Not materially. Aliaga remains priced between $266 and $288 per LDT across vessel types, far below the subcontinent.
So Turkey remains a regulated niche market.
Exactly. EU regulation and Basel Convention compliance continue to determine its business more than mainstream price competition.
Let's wrap up week 28.
The truce has broken, tanker attacks have returned to Hormuz, and Brent has moved back toward $77 to $78.
Freight has rallied, weakening the immediate recycling case for aging vessels.
Bangladesh remains the highest-priced market, but flooding has stalled yard activity and softened sentiment.
India has capacity and compliance, but the rupee is under pressure and offers remain at the bottom of the subcontinent.
Pakistan's currency and steel prices remain stable, although policy changes and renewed Gulf risk are pulling Gadani in different directions.
And Turkey has finally seen inflation ease, just as higher oil threatens the improvement.
Truce breaks.
Brent jumps.
Rivers rise.
Yards stall.
That is the story of week 28.
For the complete market picture, access the full GMS Weekly.
Thanks for listening.
We'll be back next week with more insights from the global ship recycling markets.